Hello there, and welcome. If you're working in the UK, especially in tech or finance, chances are you've come across RSUs, restricted stock units. They're an amazing perk, a fantastic way to build some serious wealth. But, and it's a big but, the UK tax rules around them can feel like a complete minefield. Well, today we're handing you the map.
And we're not doing this alone. To make sure every single detail is spot on for the 2025/26 tax year, we've teamed up with the absolute experts at Pro Tax Accountant. These guys live and breathe this stuff. They specialize in exactly these kinds of complex tax situations, so you can be sure the insights you're about to get are top-notch.
Okay, let's just cut right to the chase. You've been granted company shares. That's brilliant news. But what if I told you that one simple, very common mistake could see HMRC taking over 60% of their value? Yeah, you heard that right, over 60%. It sounds crazy, but it's a very real trap. Stick with me because we're going to show you exactly how that happens, and more importantly, how you can avoid it.
So, here's what we've got lined up. We'll start with the basics of your RSU journey. Then we'll get into the dreaded double tax hit. After that, we'll expose the hidden traps that catch so many people out. Then the good stuff, smart tax saving strategies. We'll put it all together with a real-world example and finish up with your next steps. Let's get into it. Right, first things first. Before we can even talk about saving tax, we need to be on the same page about what RSUs are and how their life cycle works. Getting this foundation right is absolutely the most important first step.
So, what exactly is an RSU? This is key. An RSU isn't a share, not at first anyway. Think of it as a promise from your employer. They're promising to give you a certain number of shares in the future, but only if you meet certain conditions. The most common one is simply staying with the company for a set amount of time.
Let's make this real. Imagine Alex, a software developer working in London. On her grant date, her company promises her 1,000 RSUs. Now, her vesting schedule is what we call a 4-year cliff, meaning she gets 25% each year. So after 1 year, 250 of those RSUs vest. At that exact moment, they stop being a promise and become actual shares that are legally hers. This happens every year for 4 years. It seems straightforward, right? But that moment of vesting, that's the trigger. That's where the tax man gets interested.
And this brings us to the first major hurdle you have to get your head around, the double tax hit. You see, with RSUs, it's not a case of paying tax just once. Oh no. You can get taxed at 2 completely different stages, on 2 different types of tax.
Here are the 2 tax events side by side. First up, the big one. At the very moment your shares vest, HMRC sees their value as employment income. That's right, just like your salary. So you're going to pay income tax and national insurance on the full market value of those shares. Then, later on, if you decide to hold on to those shares and their value goes up, when you eventually sell them, you'll pay a second tax on that growth. That's called capital gains tax.
Now just look at the massive difference in these tax rates for a higher earner. Your income tax can be as high as 45%, plus your national insurance on top, but capital gains tax, that's way lower, at 20%. This gap is everything. It tells you that the entire game of smart RSU planning is about legally minimizing that first, huge, painful income tax hit.
But wait, it gets even more complicated. Those standard tax rates are just the start. There are a couple of hidden traps that can make your tax bill balloon to honestly shocking levels. Now, stay with me here. This next part is what catches almost everyone out, and it's absolutely crucial to understand.
So, let's go back to that scary question from the beginning. How on earth is it possible to face an effective tax rate of nearly 60% on your hard-earned shares, especially if your income tips over that £100,000 mark? I can tell you now, it's not a payroll mistake. It's the painful result of 2 powerful tax rules working together against you.
Okay, here are the culprits. The first is what's known as the 60% tax trap. As soon as your total income, that's your salary plus the value of your vesting RSUs, goes over £100,000, you start to lose your tax-free personal allowance. For every £2 you earn over the limit, you lose £1 of your allowance. This is a double whammy because you're paying 40% tax on the new income, plus you're paying 40% tax on income that used to be tax-free. It creates this brutal 60% effective rate. Now add trap number 2. In many RSU agreements, and you need to check your paperwork for this, the employee has to pay the employer's national insurance, which is a hefty 13.8%. You add it all up, 45% income tax, your 2% in IC, and your employer's 13.8% in IC, and you're suddenly looking at a tax rate of over 60%. Ouch.
All right, deep breath. That was the bad news. I know it's a lot to take in, but here's the good news. You are not helpless here.
With a bit of smart, proactive planning, you can navigate these traps and slash that tax bill. So let's get into the solutions.
And here is a fantastic pro tip directly from the experts at Pro Tax Accountant. When it comes to fighting back against that monstrous 60% tax trap, your single most powerful weapon, by far, is your pension. Seriously, it's the key to taking back control.
The way this works is actually quite simple, but it's incredibly powerful. So, step 1. Your RSUs vest and push your total income over that 100,000-pound cliff. Step 2. You make a strategic pension contribution. What this does for step 3 is it lowers what HMRC calls your adjusted net income. And here's the magic. Step 4. If you contribute enough to bring that adjusted income back down to 100,000 pounds, you completely sidestep the trap. Your personal allowance is fully restored, and that 60% effective tax rate, it just vanishes. It is a genuine game changer.
Now, pensions are the big one, but they're not the only tool in your box. Another simple strategy is to sell your shares the moment they vest. If you sell immediately, there's no time for them to grow in value, which means no capital gains tax to pay. You could also transfer shares to your spouse or civil partner. This is a tax-free transfer, and they can then use their own annual capital gains allowance, which is £3,000 for the 2025-26 tax year, to sell them. And finally, once you've sold your shares, get that cash into a tax-free wrapper like an ISA or a SIP as fast as you can to make sure all your future growth is protected from tax.
Okay, so theory is great, but let's put some real pounds and pence to this to see what it all means. We're going to check back in with our developer, Alex, and see the real-world financial difference these strategies can make.
Just look at the night and day difference here. Alex's total income is £125,140, putting her squarely in that 60% tax trap. Now, in the standard approach column, she does nothing. The tax hit is enormous, and she only gets to keep about £8,165 of her RSUs. But now look at the smart approach. She takes that £25,140 that's over the threshold and puts it straight into her pension. Her taxable income for the allowance calculation drops back to £100,000. Her effective tax rate plummets, and the net value she receives jumps to £12,500. By making that one simple move, she has kept an extra £4,335. That is the power of smart planning.
So, we've walked through the problem, we've uncovered the hidden traps, and we've laid out the solutions. The question now is, what are the key actions you need to take away from this to take control of your RSU tax situation?
Let's just quickly recap the absolute essentials. Number 1, remember, RSUs are taxed as income on the day they vest. Number 2, you face a potential second tax, capital gains tax, if they grow before you sell. Number 3, and this is the big one, if you earn over £100,000, you must be aware of the 60% tax trap and the employer NICs issue. And finally, number 4, strategic planning isn't just a nice-to-have, it's absolutely essential if you want to maximize your wealth from these schemes.
Now, this guide gives you the framework, but everybody's personal situation is unique. Your grant size, your salary, your other investments, it all matters. So your best next step is to get personalized expert advice. You can contact the team at Pro Tax Accountant directly. Their WhatsApp and phone number is 079-8568-9912. You can email them at info@protaxaccountant.co.uk, and for an even deeper dive, I seriously recommend reading their full article on this exact topic on their blog. And hey, if you found this guide useful and it's helped you understand things a bit better, do us a favor and subscribe to the channel. We're always putting out new guides to help you make sense of complex financial topics just like this one.
And of course, we have to include an important disclaimer. The information in this presentation is for general informational purposes only. It is not professional financial advice, and you really shouldn't rely on it alone to make big financial decisions.
Before you take any action based on what you've heard today, it is absolutely essential that you consult with a qualified professional, like the team over at Pro Tax Accountant, who can give you advice that's tailored specifically to you. Thanks so much for watching.